All right. Now we are going to the second part. This is going to be part two, retracement continuation. So now we are going to be looking at some examples of what a retracement is, with respect to what a market structure is at the same time. So when we talk about market structure, we talk about a low, a high, a lower low, a lower high. This is said to be a downtrend, right? An uptrend will be higher high, higher lows in that manner. So, looking at this chart, we have a downtrend. And how do you, as a trader, take advantage of this particular chart and really trade it? Okay. So, all you have to do is try to figure out what the market structure is and what side of momentum, but it is almost the same, it has almost the same meaning. So, looking at this chart now, we have a high here and then we have another high. Now, these two highs, retail people who use retail methods like double top will say that is a double top and you want to be a seller right here. When eventually they take a sell and then they put their stop loss somewhere here, and the market will always like to go to where the stop is. And you can see it did just that, went up, wiped out all the stops of those who were already selling here, and eventually went down. So this is always the story of people who do not know how to trade, and all they know is that, oh, market took me out and went my way. Now, how can you be smart about this? So that the market doesn't take you out before going your way. That is literally the essence of everything. Now, using the idea of retracement, idea of expansion, just idea of the four trading elements to a trade setup, you can always know exactly what price has done, what price is likely going to do next, or what price is even doing right now. So all these things will build your narrative and would help you to make smart trading decisions. If you look at my chart here, we have a low here and we have price trading a little bit below this low, and that automatically means this low has been broken. That is known as a bearish break of market structure. Break of market structure means if the market structure is bullish, going up, as long as there is no break of structure, as long as it keeps forming higher highs and higher lows. But at some point, the market can do something like this, you know, taking out this initial low is a break of market structure. And then on the retracement is where you want to start looking for trading opportunities to go down, which is exactly what happened here. So the next time you are looking to trade, always have it at the back of your mind that uh, the market is likely going to get manipulated and you need to be smart about what to do about that manipulation. Okay. So next, we have a break of structure of this low. Then afterwards, the market went back for a retracement. Now, if we plot a Fibonacci 2, for those who don't know what a Fibonacci 2 is, when the time comes, I will be teaching how to use a Fibonacci 2. If you plot a Fibonacci 2, you'll find out that we have a 50% retracement around this area, and that is a good enough premium price to sell after the break of this low. Now, price did went down from there. Did not only also took out this previous low, and that also means we have a new break of market structure of that low. The next thing is, let's assume you were not able to get your trade here. This is another retracement back into this. We have a fair value gap here. Whatever I say and you do not know, don't worry, you will eventually get to know. Price went back into this fair value gap, precisely tapped into it, and then crashed down. As a smart money trader, this is where you buy. Sorry, you sell. This is where you take your sell for price to go down. Where would you target? You target this low. You can say I have X here, meaning this low is the first point of liquidity for you for the market to drive into. Retracement part two. We are still on this is still the part two. Why does price always have to retrace? Why do you think price have to retrace? If you remember very well, I explained this during my I think the first week. I explained that whenever the price moves in, when I was explaining impulse and momentum, I explained that the price needs to, you know, expand and then go back into that expansion or into that range for reaccumulation of orders. Reaccumulation of orders means addition of trades of positions by the major financial traders, the hedge funds, the market makers, the banks, and so on. So this is a continuous process and it is going to be like that forever. Market will always have to at some point retrace on every single time frame. Higher time frame market structure is the same as lower time frame market structure. It's the same. If you look at retracement on daily, it's the same method you use to look at retracement on the 1 minute time frame. So before lower time frame market structure, I just explained they are the same. Trade retracements using FIP tool. Okay, I used the FIP tool during the first lesson when I was talking about dealing range, but there will still be an entire video that explains how to use the tool to trade. So SMS and BMS. Now let me go back to this. SMS means shift in market structure. Shift in market structure means as long as the market is trending up, it is going to continuously form new highs and new lows, right? Higher highs and higher lows. The moment it does something different from that, that is a shift. And the major way to identify it is if market is moving up this way, let me use black now. It forms new high and new low, higher highs and higher lows. At some point, it comes down for retracement and you expect it to form a new high, but for some reason it doesn't form a new high, then crash down. The fact that it failed to form a new high is known as shift in market structure, SMS. And now taking out a previous swing low is known as BMS, break of market structure. If it is doing it to the downside, it is known as bearish break of structure. And if it does it to the upside, it is known as bullish break of structure. Okay. So finding your range, dealing range. You already know how to find your dealing range, so there's no need to go into that. So lastly, on our four element to a trade setup, we have a reversal. Reversal means you can have your market moving down, trending down, and at some point it will start trending up. What are the reversal patterns? There's a lot of them. As time goes on, all these elements, there will be topics that we have to deal with for some days on their own individually. So this is more like introductory to something. Okay. So if you look at my arrow here, I have a downtrend. And if you look at my arrow here, I have an uptrend. So at this point, the market was moving down, and at this point, market was moving up. What does that scenario? What does it say? It says we have a reversal. The definition: price moves in the opposite direction of the overall trend. So if the overall trend is down, reversal means it will go the other direction, which is uptrend. So what are the major reversal patterns are usually you start having consolidation, then you now have break of structure. After break of structure, which you see as bullish BMS here, then you have a retracement into some level of discount or premium, depending on what the direction of reversal is going to be. Then you have markets move off in expansion towards the new direction. As simple as ABC. So lastly, number four, we have consolidation. Consolidation, I've already explained, is when price moves within a small range without forming new highs or new lows. This is a non-trending market. I've explained this, and it's used to accumulate orders on both sides of the market. As time goes on, you also understand better what it means when price accumulates orders on both sides. All right, so this is going to be our teaching on the four elements of a trade setup. The assignment I have for you is you are going to open any currency pair or instrument, can be gold, can be anything, and on a single chart, you are going to identify a consolidating market, you identify a reversal, you identify retracement, and you identify expansion. You will identify these four things on a single chart. On this chart, we can see here we have consolidation, right? Here we have reversal because price was going down before and eventually started going up. We have the reversal pattern here, which is break of this high. Let me go back. Break of this bullish high, then the retracement, and then a continuation to the upside. That is a reversal. You can use this arrow to show me that. And you also identify expansion the way I explained it. When price moves away from equilibrium, you can see this arrow. Price came precisely to touch the equilibrium point and move aggressively back to the upside. That is expansion. Then retracement is when price comes back into a range it has initially created. Also very simple. All right, that is going to be all for now. I'll talk to you tomorrow and make sure you submit your assignments today. Goodbye.